Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I just wanted to share with you a video from Stephen Miran. He is the latest Fed governor on the Fed board, and he basically has reiterated in this clip a lot of what we talked about in the last couple of shows for our weekly market updates and stuff that I've gotten from Barry Habib that I just wanted to share with you, kind of reiterating where we are on jobs numbers and where we are on inflation. And why is that important? Because that's the Fed dual mandate. And to show that the Fed is way behind the curve, not really doing what they should be doing, we should be at least at neutral Fed rate, which would be closer to 3%. um, and what should happen in December. So I'm going to share my screen here with you. We'll get right into it and start right off with this. Okay, let me grab this. Here we go.
Stephen Miran, welcome. It's nice to have you.
Hi, thanks for having me back.
Does the shutdown impact or change your view of what's happening with the economy right now?
Not really, because what the shutdown does is it depresses GDP growth in the quarter when the shutdown is occurring, but then eventually the shutdown gets lifted, the government will reopen, and then that economic growth will occur in the quarter following. Now, this has been an extremely long shutdown, and so it may be a little bit worse than that. Maybe we don't get all of the growth back. But generally speaking, I think that the shutdown is not something that really influences how I think about the economy.
So how are you thinking about the economy without the official data releases? We're trying to track all the alternative data and some of the private sector data. What are you seeing?
Yeah, so absolutely, it would be better to have more data than less data. That's absolutely something that would be the case. Nevertheless, we do have some data. And I think if you look at what's happened in the last few months, you go back to the September meeting of the Federal Open Market Committee, the median participant in that summary of economic projections was projecting a three cuts this year. So a cut in September, a cut in October, and a cut in December. What's happened since that happened, since we put those projections out? Well, we've gotten new inflation data, which were better than expected, which would make one think that it would be reasonable to be incrementally more dovish than at the September FOMC, where, again, the median projection was for three cuts. And on top of that, labor market data have come out with with the labor market continuing in the trajectory it was on, which is one of gradual softening. We do have some data on openings, on new openings that are available. We have some data on wages, and we have some data on jobless claims. And all of those are consistent with continued incremental softer weakening. So I would think the reasonable thing to be is incrementally more dovish than we were in September FOMC, which again indicated three cuts for the
year. But your colleagues are not. And we didn't get that message from Chair Powell at the last meeting when it came to guidance, and we're not getting it necessarily from the comments. They're still saying inflation is stubbornly high, and we don't have really enough data to tell us what to do.
Yeah, so I think that a lot of that focus is on inflation data that are, in my opinion, somewhat misleading. And so the question is, how backward looking are those inflation data? And I think a lot of them are reliant on data that are, I think, at this point, quite stale. And when you look forward through things, I think the indications are for it to be actually coming down quite reasonably at a quite reasonable pace. And so one of the issues in the inflation data is that there's a lot of what we call imputed prices. These are not prices that are observed in actual transactions that households are engaging in. They're imputed. And the biggest one, of course, is housing through what we call owner's equivalent rent. But there's other ones too, things like financial services, things like nonprofit services that are ultimately consumed by households. And when you look through all of these imputed prices, you look at a market-based core measure of PCE, it's running much closer to the Fed's target than the headline core, than the normal core PCE is. And then when you look at market-based PCE X, something like shelter, it's running just at the Fed's target. And so I think that a lot of the reliance on inflation data is actually quite backward looking in the way that some of my colleagues are using it. And I think it's more important to be forward looking and making policy based on our forecasts for the future.
So to the degree we get a wave of updated data next week if the shutdown actually ends, what's the first thing you're going to look for?
Well, I don't know if we'll be getting updated inflation data immediately. It might take some more time for that. I mean, we have the September CPI, and so we'll be getting following PCE data, but that's not that much incremental new information. To get new inflation data that's more recent than September will be a while. We will get the labor market data, but at this point it'll be somewhat stale. So I think it's going to take some time until we have new data that's actually changing the forecast. And again, policy should be forward-looking. So the question is, what has happened that would make you think that your forecast has changed based on where it was previously? And in my opinion, there's been nothing that's occurred since the September FOMC that would indicate a change of forecast.
Are you looking, speaking of looking forward, hopeful that tax refund season, OBBBA, depreciation will feed Q1 strength, first half strength of next year?
Yeah, so I do think that some of those elements will feed into better economic performance next year as we go into the turn of the year. However, I think it's important for monetary policy to be thinking of not just economic growth as one number, but as an output gap. And so the question is potential GDP increasing more or less than actual GDP is. And when I think of some of the policies that have been enacted over the course of the year, in my mind, they're pushing out potential either by as much as actual is in the case of, I think, the tax law, or they're pushing out potential GDP by more in the case of deregulation. And so some of those policies actually make the output gap actually more negative and increase the need to cut rates.
So you favor what, another 50 basis point cut in December? That's what you wanted the last two meetings?
Well, look, nothing is certain. We could get data that would make me change my mind between now and then. But failing new information that's made me update my forecasts, looking out in time, yeah, I would think that 50 is appropriate, as I have in the past, but at a minimum 25.
So why are your colleagues, I mean, you mentioned the inflation story, that you disagree, that you think it's backward looking. They're also, Fed President Schmidt, who was a dissenter and the other way, didn't want to cut rates last time. In his dissent, when he came up, we pulled up the quote, we can pull it up again. He was saying the economy is doing quite well. Unemployment is low. Stocks are near record highs. Credit spreads are near record narrow. So what is telling you there that the economy is restrictive? Here we go. Modestly restrictive, he says. Financial market conditions appear to be easy across many metrics, as I just said. The equities, the corporate bond spreads, high yield bond issuance is high. None of this suggests, he says, that the financial conditions are particularly tight or that the stance of policy is restrictive. Why do you disagree with that?
Yeah, so a couple of things. First of all, Congress didn't tell us to make policy for financial conditions. It told us to make policy for maximum employment and for stable prices.
Sorry about that, guys.
And financial conditions are a tool through which we work to achieve those goals. But even that said, I look at financial conditions, I don't see the same thing. Sure, there are parts of financial conditions where they seem quite loose, and you can sort of look at valuations in some equity markets or credit markets, but there are other markets where they appear quite tight. You look at something like housing, and I think that it looks like financial conditions are quite tight. And when I think what matters more for economic growth and therefore for the labor market and for our price mandate, it's absolutely going to be housing relative to equity markets any day of the week. And on top of that, you see stresses emerging in some private credit markets. Those aren't going into the price indices that he's looking at when he's quoting something like that. So I think the situation is much more nuanced than what he described. But I also think that it's important, as I said, to be forward-looking on these things. And when you sort of extrapolate continuing softening in the labor market based on what's happening on this stance of policy, and you extrapolate continuing declines in inflation based on the catch-up of shelter inflation to actual market rents, which are very, very, very low, and based on ignoring some of the fake inflation and the imputed prices like portfolio management fees, it seems to me like we're heading to a situation in which inflation is going to be coming down quickly. The labor market is continuing to soften.
Some people are still worried that the tariff inflation hasn't fully showed up yet.
People have been worried about that all year long.
I know, but that's still, even if you say inflation is backward looking, they say, okay, well, there are risks to the upside going forward.
They've been marking their forecasts for tariff inflation down all year long. People have been moving in my direction on tariff inflation all year long. And on top of that, if tariff inflation does materialize, it is the definition of the type of thing that the central bank should look through. If tariff inflation were to materialize, it is the kind of one-off fiscally driven price increase that is not indicative of underlying changes in supply and demand, right? You worry about second round effects if demand is outstripping supply, and therefore there's going to be persistent upward pressures on prices. If prices move higher because there's a fiscally mandated price change, whether it's a tariff or a value-added tax or something that happens in healthcare or whatever it is, that's not the type of thing that gives rise to persistent demand outstripping supply that would cause persistent inflation effects. It's the definition of the one-off that the central bank should look through if it were to materialize.
Waller's argued that too.
All right, guys. I think you get the point. I'm sick of these ads here, and nope, I'm not going to edit them out. So I just like to make these real little videos for you. And, basically, it's the same thing that Barry Habib mentioned, four-time crystal ball winner. What he says typically happens about 99% of the time, unless the government just completely screws it up. So there you have it. When it comes to inflation, they're definitely way behind, as we already talked about. When it comes to the labor market, you take the aggregate data, it's been totally dismal. And one of the things that Barry talked about too is the idea that, a lot of people work mobile now. A lot of people work mobily in many different states. And a lot of times they're counting those jobs multiple times. So that's a very inaccurate picture of what's really going on. And he breaks that down. And basically, over the last 3 months, he's saying we're negative about 10,000 jobs. I wish they would. I kind of put this out there on some of the boards and messages, and I'm like, he's on the FA board with Bill Pulte. I wish they would put Barry Habib out there at a press conference and have him explain these things, to the American people. Not that everybody's watching press conferences, but at least if it gets out there, maybe we get some articles going and some other stuff out there. And besides people like Stephen Miran, we get somebody who's actually, Barry Habib's worked in the mortgage industry for decades. So, anyways, guys, I hope that helps reinforce some of the things we've been talking about a little bit more. We'll talk to you guys next time, and we'll have our weekly market update coming up soon.